Inventory journals or stock journals address how we keep records of transactions relating to inventory, or what we sometimes refer to as stock. They are pretty straightforward, so let's get stuck into these examples straight away. Econet purchased $60 million worth of inventory during the current month. It received credit terms of 30 days. What would the journal entry be? Firstly, there would be a debit to the inventory in the balance sheet of $60 million. That increases the value of inventory Econet has. At the same time, there would be a credit to the accounts payable of $60 million. What's that showing is that Econet owes the supplier money because they've purchased this on credit. How would this be reflected in the T accounts? If you had to see the journal reflected in the T account in GL, you'd see a debit of $60 million in the inventory T account and a credit of $60 million in the accounts payable T account. Let's do another example. Econet purchased $35 million worth of inventory during the current month. These purchases were paid for immediately. What would the journal be then? It would be a debit to the inventory in the balance sheet, increasing the inventory amount by $35 million, and then it would be a credit to the bank and cash because the amount was paid for straight away. That would be a credit to the bank and cash in the balance sheet. And if you had to see the journal reflected in the T accounts in GL, you'd see a debit of $35 million in the inventory T account and a credit of $35 million in the bank and cash T account. One final example. Econet purchased $100 million worth of inventory during the year. All amounts owing for inventory had been settled by the end of the year. The opening inventory at the beginning of the year was $20 million, and the closing inventory at year end was $15 million. What would the journal entries process be? Firstly, you would debit inventory in the balance sheet, $100 million, and because all of this inventory had been paid for, you would credit the bank and cash in the balance sheet, $100 million as well. That journal reflects you capturing the inventory purchased and the payment for that inventory. The next journal would be to debit the cost of sales, $105 million, and to credit inventory, $105 million. How did we come to that $105 million? We basically said the cost of sales is equivalent to your inventory opening balance, which was $20 million. You add on the purchases that took place during the year, $100 million, and you minus the $15 million closing inventory amount. That's how we got that figure. If you had to see these journals reflected in the T accounts and general ledger, you would see the following. For the first journal, there would be a debit of $100 million in the inventory T account and a credit of $100 million in the bank and cash T account. For the second journal, there would be a debit of $105 million in the cost of sales T account and a credit of $105 million in the inventory T account.